Today's episode features John Ruffolo, founder and managing partner at Maverix. It was such a pleasure to have John on the show. He's had a legendary career in the Canadian technology industry and is one of the people largely responsible for helping grow it. He founded OMERS Ventures, which invested in over 40 technology companies, including some very well-known ones like Shopify, which we spoke about. Now he more recently founded Maverix Private Equity, which is focused on the growth stage and really trying to take companies from 100 million to 1 billion and beyond. We spoke a lot about the Canadian technology ecosystem, what it takes really to build successful companies. We spoke about the pension fund side, the LP side, and what it takes to be a successful investor, and this notion of pattern recognition. Beyond that, we also spoke about cycling, of course. So we spoke about how John came back from a horrific accident and has really shown a lot of resilience and courage. And of course, very selfishly asked questions about investing as well as cycling. It was such a pleasure to have John on the show. He was a true inspiration. I hope you enjoy today's episode. John, such a pleasure to have you on. I've been waiting a long time for this interview, and I'm really glad you took the time today. And we have so much ground to cover, but also want to be respectful of your time because I know you're obviously a very busy person. The first place I want to start is purpose, right? You've had a legendary career in tech. You've influenced so many companies, so many founders. What keeps you going after all these years?
Well, first of all, thank you very much for the opportunity. Yeah, and in terms of the purpose, and we've really baked it into the whole underlying purpose behind Mavericks is really about the future of Canada. Uh, Many folks, I'm sure, are concerned about where are we heading as a nation. We have a wonderful country, and one of the challenges, or one of the biggest challenges, is really where are we going to pay, or how are we going to pay for all of our great social services and the standard of living in which we've grown accustomed to since the end of World War II. And we are in a new world. We are in a digital world where Canada has not been very well equipped to fight. And unfortunately, we're getting into a very dangerous world as well too, with a lot of the conflicts that we're now seeing around the world. And why we created Mavericks was to really support, first and foremost, Canadian-based companies, but to help Canada grow its wealth and not just be about subdividing an ever shrinking pie, but trying to grow the pie so that everyone could benefit from it.
Yeah, I think it's a great answer, and I find obviously Canada's economy is not known for it's known for natural resources, mining, etc. But it has a few golden gems in tech, right? And I think you're partly responsible for kind of kickstarting part of that technology revolution, and maybe talk about the future a bit because I find it's a fascinating subject. We spoke about geopolitical tensions, aging demographics. What do you see in terms of like what's necessary to up level the Canadian technology sector, right? As a single digits percentage of GDP today to become something much more impactful. What do you see as the big pieces needed?
Yeah, so I mean, it's a very complicated question, but let me just kind of break it down into one piece of that. I think people confuse productivity and innovation all the time. Um, it's very clear that we have a productivity issue in this country, and one that's been an issue for 20 years and counting. And productivity is measured across all industries. And for lack of a better definition, it's really the adoption of innovation um, to make your goods, uh, either cheaper to produce, i.e., less human involvement, or B, um, to make them higher valued, either one, so either numerator or the denominator. Innovation, on the other hand, is really uh, driven predominantly, not exclusively, but predominantly by the development of technology. And we have a very good educated pool of folks who are doing that. Maybe it's not enough. And we always talk about how do we get more capital or more talent, et cetera, to the innovation part of the landscape, and that's an area where I've spent most of my career on. But funny enough, the real value from a growth or generating wealth for our nation is really on the productivity side. And one of the big concerns that I have is that right now we're not doing a whole lot in order to juice those numbers. And in fact, the old criticism for Canada was, are we the drawers of water and hewers of wood? Uh, and as the world is undertaking a complete reordering of the world, and we're becoming less global and perhaps more America centric. When you look at the United States, what do they say is the first thing that they value Canada? It's our natural resources, and it starts to get very concerning again.
Yeah, it's a such a multifaceted topic. Like you said, it's not very simple to kind of debate on a podcast. And we could talk about one example of, like, let's say Shopify, right? You guys obviously invested in Shopify, and with OMERS helped keep the big American VCs at bay. And that
Yep,
company, created thousands of well-paying jobs, people that, created families, bought homes as a result.
yep,
And I think the next generation of Canadian technology is gonna be obviously be in line with that spirit, right? So helping Canadian businesses, Canadian consumers be more productive. So yeah, I find it's something it's of national vital importance, strategic importance,
absolutely.
particularly.
Yes, and I would call that example of Shopify is a great example on the innovation agenda. So you see a company that was very small, kept them here, financed them here, they grew here, kept their head office here, and it created this innovative company largely driven by technology. And remember, they make e-com sellers more productive, right? There's the productivity angle. Um, but this company grew so greatly that it added very good wealth, particularly to the city of Ottawa. It was funny when they went public, there was an actual blip that they saw 3 to 6 months later as I'm buying homes in the local economy. And it was just interesting to see the immediate impact of simply one company in the country.
Yeah, I remember the example of Radiant Six, which I think also was acquired, I think in the
Yep.
early tens, and I think they were based in St. John's, but they're definitely out
Yes.
in Atlanta, Canada. And it's the same scenario. Once they were acquired, like
Huge.
1,000 millionaires or something, and then like they bought a bunch of homes, which you can't argue is obviously good for the
It's
country.
awesome. It's
Yeah,
awesome doing that. I mean, ideally, it's not an acquisition, it's an IPO, because the difference is on an IPO, it's just a financing event, and you're not losing the future value creation outside of the country. But make no mistake, Radiant Six was a huge boon to the local economy.
yeah. And is that why you started Mavericks? Is that you saw that funding gap that you want to start writing $100 million checks to keep local ownership and for IPO and beyond? Is that kind of the raison d'être?
Yeah, in 2010, when I was contemplating to move to OMERS, there was a three-phase plan that I wanted to undertake. And if you were to overly simplify and divide companies into three buckets: companies with revenues from 0 to 10, 10 to 100, and 100 million to the billion plus. When we had first launched OMERS Ventures, it was being designed, at least first, to deal with the 0 to 10. But it became quickly apparent that a number of those zeros were going to 10 very quickly already. The problem then we started to move to the 10 to the 100, not exclusively. We were, mixing the two, but clearly we saw we got to get companies to the 100 million. And that went on for a number of years. And I then was starting to embark on, okay, now that we got a whole bunch of companies that are starting to approach the 100 million, how do we really take them to the $1 billion plus, i.e., the next Shopify, BlackBerry, etc.? And that's when I created Maverix in order to exclusively focus in on that third stage of the problem set.
Yeah, you guys raised, if I'm not mistaken, 500 million,
Yep.
approximately. Like portfolio construction would be 10-ish companies, from what I understand, and you've invested so far in three, if I'm
Yes.
not mistaken,
Yes.
publicly.
Yes. Yes.
So how's it going so far since you've launched? Like, do you see many opportunities? Like, how do you think about the funnel? Curious to like dive to how into your business and how you look at the opportunities themselves.
Sure. Yes. So, when we started, we knew that we were at the top of a bubble, and we knew that this bubble was going to burst. We didn't know exactly when or how, but we knew what the impact would be, and it was going to be ugly. So we resisted the temptation to deploy our capital too quickly, on the basis of investing in companies that were either, very, very high, unjustifiable valuations, or B, burning huge amounts of capital that we just knew was unsustainable. So we always had the ethos of sustainable growth and profitable growth, ultimately, which was not the flavor of the day, but it has been the flavor of the day for the last 20 years before that, with the exception of the last few. So we know it would revert back to the mean. So we resisted the temptations to deploy quickly. And in the interim, we did meet with a lot of companies. So I think I haven't seen the last count, but in 2.5 years, we've screened about 2,800 companies. Maybe we're approaching 3,000, and we've done three. So now, a number of those companies weren't really ready to be growth companies, and they were a lot of them were very early. And you know what's happening right now is, and you had indicated a little bit earlier, is that on the growth strategy, it really is a growth private equity strategy, and the private equity being its highly concentrated portfolio, where our average investment size is around $75 million. So you need to have a very high level of commitment that you believe this is the opportunity. Number one. Number two, um, when you do find the opportunities, um, I'd say companies that were financed between 2019 and 2021, many of them have a bit of an albatross around their neck in terms of a very, very high valuation. And those with high valuations from a recent financing, but still a lot of capital on their balance sheet, a number of the founders are basically hoping for time so that they could perhaps grow into their valuations. And and I would say over the last 18 months, particularly the last 6 months, the separation between the bid and ask price has been closing quite dramatically. It's not completely closed, but it was so far apart, 12 months, 18 months ago, that you will see more financings and more M&A transactions, but the ones that you're seeing right now, a lot of them are in a situation where they really don't have much of a choice, or else they'll have just no cash. The ones that are just were unsustainable, no one's touching them, and they're just going away very, very silently. And the ones that are exceptional tend to have luxury of time, but eventually this all catches up. So I do anticipate a lot more closings of transactions. I just don't know exactly when.
Yeah, it's interesting. Yeah, you mentioned like this notion of just back to business fundamentals, right? So it's like, like profits are cool again, and then yeah, this whole valuation reset of if a company got ahead of its skis in terms of valuation, well, they'll need to take a down round. And it's funny, so like sometimes founders I speak to like see it as a very negative thing, but it's like public stocks go down, right? Like, and we see that often. Like Facebook had a 50% drop. Doesn't mean
Oh
the company
yeah.
is 50% worse off. So down rounds,
Yep.
it isn't the end of the world, of course, if the
No.
business is sound.
Fight for another day. What's bad? Going bankrupt is bad. You're done, right? And having a down round does not mean you've gone bankrupt. In fact, having a down round might be the best thing for your employees, because if they're getting options, or if you have them buying them into stock at inflated values, you're not doing them any favors either. And the investors who have come in, I mean, they're sophisticated. Just like you said, hey, sometimes you win, sometimes you lose, but play for another day is assuming they're quality companies in the first place, is really what folks should be focused in on.
Yeah, and of course, you guys are going after outliers, right? So, like taking a company from 100 million in revenue to a billion and beyond, and you probably know better than most, the power law, right? Companies that continue
Yeah.
compounding over time. I believe Shopify, when it went public, was just over a billion in terms of market cap, and today is so somewhere north of 90. Have you
Yeah.
thought of that holding period post IPO and what that means for returns for your fund, or you will distribute and let the LPs choose if they want to buy the public stock or not?
Yeah. I mean, when the markets rise so rapidly, you know, uh, you could look back and say, oh, Jesus, maybe I should have held on. But, the reality is most LPs, once you have freely tradable stock, have no desire for you to charge them a management fee in order to hold public company stock. So, what most good VCs do is that once they're freely tradable, they distribute the shares to the VCs. Sometimes, what they'll do, they may get an instruction to actually sell on their collective behalf and distribute the cash. Um, but then your job is done now. Your job to influence is done. And if your target return was to get a 3x, say, return, and you're already at 5x, and now you're saying, but you know what? If I hold on to this, I know it's going to go 10x. It's not your problem. That's why hedge funds are there. And it's time for you to let somebody else take over the risk of holding those investments. Now, you look at, let's talk about the opposite side. There's some well-known situations now, most recently Sequoia, where they changed their strategy and they held on to the public stocks and had gone through a complete meltdown of their stocks, and in fact had to reduce their management fees back to their investors. And Sequoia is an outstanding firm, but this is the most that I've seen them tarnished in the last 30 years. So, you know, you can see if it moves the wrong way on you, it could be extremely damaging to you as well. So, sometimes you win and sometimes you lose.
Yeah, yeah. What's the expression, right? The predictions are very difficult, especially about the future.
Yeah,
Um,
yeah. Yeah. And as somebody told me this was something they told me about 30 years ago, and I've never forgotten. when somebody passes around the plate of cookies, take all the cookies you can get because it may not come back around again. It's like, yes, you're right.
So when you're partnering with an entrepreneur, then what's the value creation strategy like to help them go from the, the when you guys invest to that IPO or $1 billion milestone? Is it just really board strategy? Is it having an operating team? Like how do you then how do you think about supporting the team?
Yeah. Now, this, that answer varies depending on the stage of the company formation. So, what's ironic in the venture investing strategy, and again, I'll speak for myself, there's a perverse inverse relationship between the amount of time you spend and the success, the ultimate success of the company. Let's take Shopify. I like to think that, we did everything that Shopify asked us to do, but Shopify was smoking on its own. The best thing that we really could do was stay the hell out of the way and not get in their way and be available for the moment they needed something. And there, picking the right company is the right thing, is the most valuable thing you can do. The same thing, so call that the A portfolio. On the C portfolio, if you've just picked wrong, no matter what you do, you will not change the course of anything. So really it's about the B's in the middle. And then the B's in the middle, what you can do is, you could change the course of, maybe you're going to get 50 cents on the dollar. You can convert that into a buck and a half on the dollar. And so you can help on the edges, no question on there. But at the end of the day, you know, investors are not running the businesses. They're providing the support. Now, on the growth side of the business, where we have a very concentrated portfolio, and then you go further on the buyout where you own the portfolio, the level of value creation does go up dramatically, just because you can devote a lot more time to a lot fewer companies. Now, in our case, we really just try to drive value in four areas. The first and foremost, and it's absolutely table stakes, is just governance, right? How do you help an organization make uh, quicker and better decision making? Is really what you're doing from a governance perspective. And everybody who has a board seat better be focused in on that. But aside from that, uh, the three areas where we drive the most value is growth. And when I say growth, helping them on organic growth strategies. M&A, again, every good investor should be able to help, but understanding the various distribution channels, the efficacy, how do you get the whole organization moving in the right direction? That's number one. Number two is talent. And when I say talent, not necessarily hiring, helping them hire folks, because by this time they'll have the sophistication to do that, but looking at organizational design. And again, helping them enable the organization so that the person who, at the most junior person, has the requisite KPIs to be measured that can roll right up all the way top on the organization. And the third thing is, and this is specific to us, we believe that you will have disproportionate growth if you adopt innovation to make your product or service bigger, faster, better, or having greater customer insights. So we introduce or help them or coach them with their innovation strategies, particularly as they're seeking productivity in their businesses.
Yeah, no, it's fascinating. I love those different tiers. I particularly like the one around alignment, right? So aligning the entire organization around common goals, a common mission and vision. And something you mentioned right at the start is maybe the most important job a venture capitalist has to do is picking, right? That is the ultimate kind of determinant of success. And I'd love to hear you. Obviously, selfishly asking here to learn what's more important, the notion of the team or the market. And sometimes I find myself even asking if that's the right question to ask. So that's why, again, selfishly, I'd love to learn
Yeah.
your perspective.
Yeah, it's I get asked this question a lot, and um, I would say, uh, uh, despite how some VCs like to hold themselves out of as visionaries, etc., I'd say for the most part that's full of shit. What is true is being a pattern recognition expert, and that only comes with uh, trying to extract as much deal flow, quality deal flow, ideally, as possible, and using all of the distribution techniques to both get the highest quality and velocity of both inbound and outbound deal flow. When you have um, uh, so much of that deal flow, you start to recognize patterns. And so then when you start to evaluate, and it's really three major evaluations, the percentage and degree changes depending whether you're early stage to late stage, but it is about the people. It's secondly about the problem that you're trying to solve, the the size of that problem of and whether your product or solution uh, has an interesting way on how you might be solving that. And even on that, if it's very early, that becomes almost less important because it's going to change so much from the day that you first invest to years later. But what you're assessing there is, I want to see how your brain works and how would you solve that problem. And then the third thing is really on the financial side. So on the financial side, when it's early stage, that is such a small sliver because the reality is everything's bullshit. Everything's a made up number ultimately at the end of the day, all the way until you get to the buyout stage where it's largely a financial transaction and financial becomes more important. But the one thing that's first every time, no matter which one of the three, like whether you're in venture, growth, or buyout, is the team. Because ultimately, unless you're mining a gold deposit, um, most of these products and innovation or solutions in the innovation space really involve the quality of the team being able to both determine the solution and to distribute the solution. And if you have a great team in a so-so market, generally does better than a mediocre team in a very good market. Because if it's a very good market, it tends to be a very competitive market, and that team just gets crushed in the market. But where my personal blind side has been is sometimes I dismiss uh, excellent teams in mediocre markets that I define as too small. And again, getting very specific, where I get blinded sometimes is when a market is too small, I then try to imagine, how do I horizontally grow the market with complementary products or services? Or B, how do I verticalize the market and dive deeper into the supply chain? And my brain tends to go horizontal and not vertical, because vertical is a lot harder. And so I've missed out on some excellent opportunities of a great team in a perceived small market where they kept on digging vertically. So that's a good example of then, having years and years of experience and seeing enough of these, you start to catch where your blind sides are. It's never perfect, but I'm at least, it's taken me a while to know where sometimes I just, fail to have my brain go naturally.
Yeah, that's just such a fascinating insight, John. And I find mine, I find like I've dabbled with some angel investing, so obviously earlier stage. And at that stage, I find it's really just about the people. But then as I've seen other companies grow and mature, I find it still remains a lot predicated on the people because it's the people that are choosing the market, right? So you mentioned this
Yeah.
notion of agility, of being able to how the product changes over time. And I like the vertical aspect too. It's like, a Montreal company that everyone knows, Hopper, that horizontally they tried hotels, they tried other markets, but the one that really worked was integrating and building a fintech product on the vertical side, which enabled huge growth. So I
Right.
think that was an interesting insight no one saw coming. And again, kudos to the founder.
Right.
And maybe a previous point you mentioned, to dive into, it's all predicated on quality deal flow. So quality founders. So I find, as I think about the supply chain and in the venture capital industry, it's returns are just predicated on, do you have good people that you invest in, right? I'd be
Hmm.
curious to hear your thoughts on the Canadian funding landscape for talented founders. I find it's not like Canada's the best kept secret anymore. Maybe it was the case 10, 15 years ago. So I find that Canadian VCs are not doing a good enough job. There's too much of a funding gap, I find. And maybe we could talk about LPs after that. But I find the best founders are going to get funded. They're just going to get it from international sources, right? So maybe you feel free to violently disagree, but I'd love to hear you on that side.
Yeah. I mean, history always repeats itself. So, following the .com bust in the early 2000s or 2001 to 2010, it was a desert, and really, uh, with some minor exception, there was no domestic VC firm of any substance, uh, probably from about 2004 onwards, because they couldn't raise any more capital. And not having domestic sources of LPs that were engaged in the ecosystem was a real serious problem. So a lot of the effort was focused in on enticing foreign based um, sources of capital to come into Canada. The problem with that is you'd always need a strong domestic network, particularly at the early stages, in order to attract the larger foreign ones. And like what I've always kept on saying is, for the most part, when there's rising markets, foreign capital comes rushing in. And the moment something happens, they are the first ones exiting out of the door. And who's been stampeding out of Canada? All of the largest foreign based ones. You name it, whether it's Tiger, Coatue, SoftBank, boom, they're all out. This is not a criticism. This always happens. It's happened for 30 years. And it's because they go back to their home country where they've established their reputations, where the vast majority of their LPs might be. And they got to protect what they've got there. So it's not that they don't care about Canada, but they really don't care about Canada, like the way that I started off this conversation. So, what is important is domestic sources of capital and then using foreign sources to supplement it. Now, what are we seeing again? Now that we are seeing the implosion of a lot of the venture markets, where we've seen the foreigners retreat back because they're seeing cheaper deals back in their home country, closer to home, etc. The problem that we're running into Canada is our domestic source of capital is very limited. And and as a result, the question is, can we establish enough critical mass of of VC firms in this country with our domestic sources? You could certainly raise capital outside of this country. It is extremely difficult, and it's more difficult now because, again, if you're a pension fund in the United States, they are focused more so on U.S. based firms again right now. So the thing to watch out for is, will the VC firms that are Canadian based survive or have enough capital in order to place the risky bets that they need to place? And this is the thing that I like to always tell folks, is that somebody says, oh, the Canadian VCs, they just don't have the right risk appetite. I call total and utter bullshit on that. And I'll tell you why. It's really about portfolio construction. So if you are in first fund one, maybe fund two, and you're $100 million fund, you've got to be very, very careful on how you deploy the fund and how you mitigate what we call the J curve effect. And your ability to place bets. If you've raised $1 billion, then what you can do is that you can construct your portfolio in a manner to take much more risky bets. So it's this perception of the capacity to take risk. And in some cases, yeah, I don't dispute it. But in a lot of cases, it's really about the availability of capital. So, like I just mentioned about Sequoia, and Sequoia, again, I haven't seen its latest returns, but let's just pretend they're going to have the shittiest returns that they've had in 20 years. Let's just make that up for the moment. Might be the case. Do you think people are going to avoid Sequoia, or are they going to go, don't worry, I'm going to invest in your 18th fund because I did the prior 17, right? But if you have only done one fund in Canada, or if you're a first time fundraiser, brutal. And even folks in the United States right now, my friends over there who are doing a first time fund in the United States, are saying to me, it is brutal out there for a first time fundraiser in the United States as well.
Yeah, I can definitely feel that as I'm embarking upon a first time fun in terms of
Right.
its
I
difficulty.
don't need to tell you, I
Yeah.
guess, right? Yeah.
But maybe just to play devil's advocate for a second, the argument, I've spoken to friends that work at fund of funds, and their argument is like, well, fund performance in Canada hasn't been that great if you compare it to its American peers, and the pension funds here will invest in both the U.S. and Canada. What are your thoughts on that in terms of like VC performance here in returns? Versus, let's say, the American counterparts, and the argument being is there's just much more capital in the U.S., so it's much more diversified. Versus here, it's much more government focused, so it's like it's a more limited pool of capital, as you said. Um, so just throwing it there, I don't agree with the statement, but it's just taking the opposite
Yeah.
side for a sec.
Yeah. So, you know, uh, all you got to do is go through and look underneath and understand which data sets are you comparing against, right? So let me give you a very real example. Um, at the end of the day, it is about outliers drive, absolute top performance in VC funds. And the last study that was done, it wasn't very scientific, but Andreessen Horowitz did it, and they had concluded that approximately 15 companies. This is before the whole unicorn craze of the last few years, so take it with a bit of a grain of salt. But they said that there was 15 companies in the United States per year, per vintage year, that accounted for 90% of the venture fund returns. And their job was, as long as you got one of the 15 of those annual portfolio companies, your fund is smoking. And what's happened is that top tier in the United States, and there's about 8 of them or so, but certainly less than 10, they get their disproportionate share of those 15. And in fact, a few of them get 3 or 4 of them. And so they get it because of their longevity and their consistent track record over the years. And large pension funds, just like any other procurement, like to go with the safe bet. This is why emerging managers have a devil of a time. And so what happens is they get more of the capital, they can place more of the bets, they can take more of the risk, but their brand allows them to attract the best deal flow. And again, I go back to, if you could suck in the best deal flow is the absolute key to success. Let's compare this in Canada and let's use the typical 10-to-1 proxy. That means in Canada, there's one, maybe two annual vintage year unicorns. I'd argue it's probably less than one, but let's just say there's one a year. You have to get that one per year. There's not a whole bunch more. That's number one. Number two, the companies in Canada tend to be, I'd say, more the risk return profile is more approaches the median as opposed to the outliers in the United States. So, as an example, would there have been a Facebook in Canada? Probably not, really. Uh, 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 and I certainly would not have invested. I would have thought it was a zany idea, and I would have missed out on it for sure. Um, and and so if you are a Canadian VC and your odds to really have the, you know, outlier return is really predicated you on investing in that US unicorn, you're going to lose out because either A, there might only be one per year in Canada, or B, there might not even be the one. I'd argue to you that, when you look at Shopify situation, and and people always say, "Oh yeah, I'm investing in the next Shopify in Canada." Well, the sad truth is there's only been one Shopify in the last decade, and no one even remotely close to that. And Shopify is the outlier. And so in Canada, there's been a lot of very good companies, a lot of them funded by US folks. Um, but there's not like, the number of Canadian companies that have exited for more than $1 billion is not a very, very long list. So now you run that profile across Canadian VC firms, and they will do fine compared to the median. But on the outliers, the Sequoias, etc., yeah, they generally won't perform very well for the reasons that I had stated.
Yeah, yeah, no, that's a very good experience perspective for sure. And you were obviously famously critical of our pension funds back when you started the VC
Yes,
branch for OMERS. What would be your advice for pension funds today?
I'd say invest in innovation, and particularly Canadian-based innovation, because don't let the government do that for you is what I would say. And that's what, back in 2009, I wrote a proposal for the federal government to create a 1% pension tax. And basically what it was to force pension funds that and by the way, this model applies to a few of the industries that procure government contracts. So, like aerospace, for example, it's called the IRB program. Well, pension funds are a function, they're a creature of the tax construction of our Income Tax Act. And in fact, we have the most advanced pension legislation in the entire world that enabled pension funds to aggressively expand, and that was done by virtue of through the Income Tax Act. And so and with that uh, opportunity should be responsibility. And it's not to suggest that governments should tell pension funds where to invest, because I think you're going to get into a bigger problem, and that's going to be politicians just trying to get their pet projects financed. But uh, you know, the the shock to me back in 2010 when OMERS approached me, when they called me up, I thought they were going to call me to yell at me to say, knock it off. Well, they did say that afterwards, but uh, they said, hey, we want to do this. We want to invest. And I was like, holy shit, really? I'm stunned. And he goes, yeah, but we don't know what to do. Can you outline how we should do it? And when I did ask them, well, yeah, I can, but why are you asking me? And they said, well, because you've been a pain in the ass and, you think you're so smart, why don't you do it? And I kind of chuckle at that little bit, but, we're starting to hear this again because again, the best time if you're a pension fund to be investing in innovation is not 2 or 3 years ago. It's now because things have come back down. And we have this amazing tendency to invest in things when prices are going up and then, selling them when they're coming down. It's like, dudes, it's the other way around. Back off when they're getting way overpriced and pile in when, and again, prices are not cheap right now, but they're certainly reasonable.
Yeah, they're correcting for sure. And maybe to start kind of like finishing off our conversation, John, I want to maybe talk about a little bit about legacy. You've been a community builder. I think you obviously started OMERS, started the VC branch. You started Maverix, as well as the Canadian Council of Innovators. What do you think about this notion of community, specifically in tech? Right, I find it's something that's personally very attracting to me because I find we share a lot. It's very open. You have a sense of like we're in this together, even though there's sometimes friendly competition. Having been a community builder, what are your thoughts around it?
Yeah, I mean, I'm not doing any of this stuff for legacy because who the hell knows what that legacy could be, and at the end of the day, no one gives a shit when you're dead anyway. So, but what really got me to pay attention and to start to focus in on the whole space and my commitment was really after the birth of my first child. And I started getting involved in public policy. This was back in 2005. And I sort of dreaded the day where, you think you're a highfalutin big gun and we leave this country in a worse place for our own kids, and then they ask you, well, gee, thanks a lot, you made it worse off for me. What were you thinking? Well, at least this is my part to play so that my kids, who now obviously are a lot older, do appreciate what I'm trying to do, and at least understand that I'm trying to make it a better place for them to live and eventually die in, as opposed to looking at someplace else. And I get terribly uh, concerned when I hear young folks in universities deciding to go to the United States just because they think it's greener pastures. That's when we have a serious problem in this country. And I just don't want them getting to that point. So that's what I'm really focused in on.
Yeah, I think it's very honorable mission for sure. And I would be definitely remiss, John, if we don't talk about cycling. I'm a fellow cyclist,
Oh, yes.
so from what I understand, you're back cycling. So like, how do you feel about the sport today?
Oh, I love it as much today as I did before. And, I cycle about 2/3 inside on my Peloton and then 1/3 outside. I have a recumbent bike that I kind of strap my feet into the pedals, and then I'm able to pedal, not as certainly as fast as I used to, but I'm back up to about 25 kilometers an hour pedaling. And I think that I'm on track. Last time I looked, to have cycled 2,200 kilometers this year. And, it is kind of funny when I get a little bit of odd stares where people kind of see, you know, this funky bike that I have. My feet are kind of strapped in. It allows me to give the greatest amount of force. And then, I'll ask one of my buddies, can you help me out? And then I'm kind of climbing on them and then go into a wheelchair, and you get these horrified people going, that guy just cycled past me on the street or the path, and the guy is paralyzed. Like, what the hell? Uh, and I kind of say, hey, folks, don't worry. I've been cycling for a long time. And so bizarrely, my cycling legs have come back before my walking legs. And I do walk every day. I walk in a walker though, but I practice everyday walking. My walking gets faster and faster every day. But, my gait on a treadmill is closer to 2.5 kilometers an hour, which is kind of where, if you're doing a casual stroll in the park. But it's 7 days a week of physio every day, every week, every month. And you just cannot think about it because the amount of time suck is nothing short of painful.
Yeah, yeah, it goes back to compounding, right? So it's kind of like, it feels like such a miracle what you're describing, and really truly an inspiration, John. Like, not just in the tech sector. I think for just anyone that talks about wants to hear like a story of resilience and courage. And with that, John, I think pretty good way to end the conversation. I just want to thank you so much for your time.
Great. Well, thank you so much. I appreciate it.